Okay, so let's rock and roll. So welcome everyone. And what we're going to do is we're going to embark on this journey now to try and share and explain what I learned at the Investor Summit. And we're going to be going through it. And I'm sort of just going to go one each week. I'm going to go through one of the lectures that I thought was, hang on, where's the speaking? I'm just going to mute everyone. If you need to talk, you can just unmute yourself. Okay, because there's some feedback coming from someone. I don't know who it is. Okay. So I do need to just say up front that when I do these things, I'm not giving financial advice. I'm doing my best to share with you what I heard, what I learned, what my insights were. But obviously it's not financial advice in terms of that process. Okay, so if we go to, let me open up I want to share with you my screen to show you how I'm going to do this. So, okay. So basically, I've got the Investor Summit as a seminar, and then you got my summaries. So I basically summarized each day. And what I'm going to do is, for the next couple of weeks, I'm basically going to go through the presentation that I was the most meaningful to me. So the one that I want to start off with today is the one that George Gammon spoke about. Now, just do me a favor in the chat box. How many of you have actually read this this white paper? Does it make sense? Yes, no. I'm gonna go through it now anyway. But the point being is that. So, just quickly, don't worry, Shoni. You don't have to apologize. This is not school. You don't. So let's just look at who George Gammon is to start off with. So that's his company, Rebel Capitalist. So this is the guy basically. This is what he does. Now, interesting enough, I've actually watched his YouTube before. So if you go to his YouTube channel here, you can see that he's got 200,000 followers. And I've watched some of his videos in terms of where stuff's going, why it's going. In fact, I want to subscribe to that. Why am I not subscribed? Anyway, but yeah, if you like what I'm about to share, you can go and follow his stuff as well in terms of the process and what he's doing basically. Okay, so let's go into what he shared. So his principle, his talk was interest rates and whether they're going to go up and whether they're going to go down. Sorry, just give me 2 seconds. I'm just going to let the dog out here. John, please put the dog. In school holidays, the dogs are driving me bananas because they come in and out and in and out. It's driving me crazy. Anyway, so this was one of those presentations where the guy spoke for so long with so much data that I actually found it quite overwhelming. And long story short, I want to start with the end. Okay. So I want to sum up the entire thing, and then I'm going to give you the substance. So the synopsis of everything that he said was that the inflation and the Fed printing money is irrelevant. Like sorry. So the Fed printing money is irrelevant to interest rates. It doesn't make any impact. The thing that impacts interest rates is whether the Fed and obviously the Fed is in America, but the other, the Feds are reserve banks around the world. In simple terms, they think that interest rates will go up if they think that the global economy is going to grow, and interest rates will come down if they think the global economy is slowing down. In a nutshell, that is the entire synopsis. So what he said, if you're in business or if you're in property and you're investing and you want to look at the next kind of 2 years, 2 to 5 years, do you think that the global economy is going to grow And if you think it's going to grow, then basically you're going to have a situation where the reserve banks will put up interest rates. If you think the global economy is slowing down, then interest rates will come down. So do me a favor quickly in the chat box. Which one do you see? Do you think that over the next 2 years, so he spoke specifically in, because obviously beyond 2 years becomes harder to predict, but in the chat box, what do you think? So Camille says down. Obviously no one has a crystal ball, but this is where you would look at it. And before I tell you what he said, let's just see what everyone else says. So Camille says down, Judy says down, Janine down, low growth, slow down. Okay. We're not having a very positive Friday, apparently, in terms of the future. So the number and the essence of what he shared was exactly that. So he also thinks that the global economy is slowing down, and therefore he expected interest rates to come down. So if you look here, basically what he did was he dismantled the narrative around interest rates and the long-term direction of interest rates, particularly the 10-year Treasury, is not driven by government deficits or supply of bonds, but rather by growth and inflation. So what I've just explained, does that make sense? Because that's what I've just told you is what he basically shared. So everyone thinks that interest rates are driven by the government printing money and things like that. And the logic is that they're printing money and that's leading to inflation. And because inflation's going up, interest rates are going up. And his counter argument to that was it's got nothing to do with printing money. It's only got to do with growth of the economy. And whether the economy is growing, interest rates go up. And when the economy is not growing, interest rates go down. He then basically went through all of, I mean, there's so many slides and everything that he went through. I'm going to take you through some of them now. And he took us through what I found extremely complicated, but basically how the banks make money. So I'm going to try and share with you some stuff here. So just give me 2 seconds. Let me get the screen that I want to get up for you. So I'm not versed enough to be able to actually explain this. And that's why I would like to share with you George Gammon himself, because he'd be a better one to actually follow the process. But I just want to get the specific slide that I want to show you here for him. So this here was him presenting. And what he did is he pulled up the Bank of England. So I wrote down in my notes. So let me pull it up for you so that I can show you what I'm talking about. If we go down to George Gammon. Okay, so I'm just trying to look for that link basically in terms of, sure, I took a picture of it. Yeah, there we are. So this is where he was, you can see my screen, can you? Yeah. So he was talking about the money supply versus inflation and actually showing that there was no correlation between the money supply and inflation. Okay, so you can see there's the massive increase in money supply, and then you had the growth of inflation. And what he was basically saying is that the inflation had nothing to do with the money supply. It had to do with the fact that we had COVID and all supply got constrained and the economy was growing. People had money and they wanted to buy stuff, but there was limited things. So people spent more money. And that led to inflation in terms of that process. So what is important here is the scary thing is what he was talking about here was the derivatives market. So people that are effectively hedging the derivative market. So check out this. The BIS statistics on over-the-counter derivatives show that at the end of 2024, the notional value of FX derivatives was 130 trillion, more than 3 times larger than the outstanding cross-border holdings. Almost 90% of contracts reference the US dollar one side. So this is effectively where people are trading currencies. 90% of them are doing it with the dollar. the American debt, the entire debt of the American economy is 37 trillion. And these Forex derivatives are 130 trillion. Does this make sense? Is this scary? And this is what he was trying to show here. Sorry. I'm trying to zoom in and it's making it difficult for me. Come on, man. That's what he was trying to show here. That like actually the supply of money made no difference in terms of that process. Then you got these derivatives that are coming through. So this is the slide that I wanted to share with you. And as you can see, I can only really do this in Zoom sessions because they're not good enough quality to be put on into documents and stuff. Now, I'm not going to try and sound like an expert here because this is exactly the part that I don't fully understand. But you can see here that this is from the Bank of England. So you can basically look at what it's doing. But what they basically were talking about is where you can borrow in one currency and you can take a security. So one of the banks would take a security and they would do an FX swap with another bank. So they basically create money out of nothing. So I'm not going to try and sit and sound like an expert and talk to these because I don't fully understand it. But what he was showing is that the banks are effectively at very low risk, creating money out of nothing. And they're creating all these future swaps. And as long as the bond market in America remains stable, then everyone's happy. Okay, but what he was basically alluding to, and by the way, Robert Kiyosaki said the same thing, and so did Peter Schiff, is that the bond market is starting to crumble because people are the central banks and people around the world, when there was risk, they used to run towards the American Treasury and the bond market. It was sort of a safe haven. And now they're no longer trusting it as much. Now, I would recommend, if you're interested in this, is that, and I mean, we could maybe even do a Google search here. Let's do a quick search with old rebel capitalist here, George Gammon.
Today, welcome to Financial Repression with George Gammon.
That's not what we want. I was just going to see if we could find a video where he was explaining it better. When's this? May 21, 1 month ago. Here we are.
What drives?
Would you like to watch this quickly? It's 11 minutes. Should we watch this quickly? And then I can give commentary, because this entire presentation is about George Gammon. And he made this video a month ago, and I strongly recommend following this guy. I was very impressed. It was him and Peter Schiff that impressed me the most. So should I share this quickly? Yeah. Okay, let's do it. 1.5 speed. Okay, Janine. I'll be honest with you, when I was live in the room, if it was at half speed, I was battling to keep up. So I consider myself a fairly intelligent man. This was high level stuff. I really struggled to understand what was going on here.
The long end of the curve. In other words, what drives the long end of the curve? In other words, the 10-year Treasury yield. It's not the issuance. It's not how many Treasuries or 10-year that Janet Yellen is issuing or Scott Bessent or anything like that. It's growth and inflation expectations. So what happens is when the Fed funds is coming down, the market is perceiving that to mean that growth and inflation is going to increase. Now, this could be short-term noise, which I think it is, like we saw back in the 2008. But if you think that one through, it's ironic, isn't it? Because if we had to pick out one interest rate or one maturity that has the most impact on the real economy, it would be the 10-year Treasury yield. And so most people think that, well, monetary conditions have loosened dramatically because the Fed has dropped rates by 100 basis points. Have they? The long end of the curve has gone up by 100. So I think there's a strong argument that monetary conditions have actually tightened over the last 4 or 5 months, which again makes you question, does the Fed really control interest rates? Even at the front end of the curve. Because put yourself in the position of Jerome Powell right now. You just dropped by 100 basis points trying to bring down all interest rates. And the 10-year just basically gave you the middle finger and said, no, we're going up by 100. So, I mean, he's got to be contemplating the possibility that if he continues to drop, the 10-year might continue to go up, do the opposite of what he wants. So is he really controlling the front end of the curve, or is the 10-year Treasury saying, no, Jerome, we control the game here, my friend, and you're not dropping rates? And people will push back on that and say, oh, George, well, the Fed is just going to come in and do quantitative easing. They're going to buy the long end of the curve, and that's going to bring interest rates down. Don't you remember, 2010 to 2020? Go back in the history books, look at some charts, and see what the 10-year Treasury yield did during QE 1, 2, and 3, when the Fed was buying all of those Treasuries, trying to get the long end of the curve down. In other words, get the yields down. The yields did the opposite of what the Fed wanted, even with all that additional demand. Why? Because the market perceived that to be inflation and growth expectations increasing, so they sold more than the Fed bought. My point there, start your analysis by looking at what you think is going to happen with consumer prices and inflation expectations in the real economy. Do that first, and then try to ask yourself how the Fed is going to respond in relationship to certain scenarios. And that's how you can kind of use some game theory to set up your portfolio, or know if, there's going to be an opportunity at the end of 2025 to refinance at a lower level. If you go back and look at QE, the Fed took their balance sheet from 800 billion straight up to, or where did it top out, 9 trillion, something like that. And let's just look at the DXY. The answer, the punchline there is a lot lower. So the Fed printed all of this money, and what did the value of the dollar do relative to other fiat currencies? It went up. My point there is that the Fed's balance sheet has no impact whatsoever on the value of the dollar. I mean, you could kind of argue it might have an impact on goods and services in the United States, but again, if we're just comparing fiat to fiat, the Fed's balance sheet doesn't really make a difference. Over the short run, the interest rate can. Let's say the Fed is dropping rates while the ECB is increasing rates. Well, then, yeah, that's going to put downward pressure on the dollar relative to the euro. But that's going to be more so temporary. If you're trying to think through what impacts the value of the dollar relative to other currencies, you have to realize it has very, very little to do with the United States. It has much more to do with what's happening outside of the United States in the global monetary system and the banking system that's actually creating the majority of the dollars by lending them into existence. I mean, if things get really rocky, to your point, they'll probably go into Treasuries, which then would lower rates, right? But again, that's because growth and inflation expectations, not just in the United States, but globally, are coming down. But I think that if we do have, let's say, a balance sheet recession in the United States like 2001, the economy doesn't do that bad, but it's just the stock market goes down by 50%. And maybe housing goes down by 20% in nominal terms or something. So a balance sheet recession. For me, especially if things got cheap based on the metrics I use, that would be a huge buying opportunity, because my base case would be that over the next 5 years, we're going to see that dynamic where it is much more attractive to invest in the United States or dollar-denominated assets than other places, and you're going to see those capital flows, which will be a significant tailwind. But again, notice I said tailwind. There's a lot of cross currents here. There's thousands and thousands of variables, and that's just one variable that we need to consider. There could be other cross currents that come along that overwhelm that dynamic. But that's why we got to stay focused on this stuff, and we can't just bury our head in the sand like an ostrich. So I think it's regional. DC is going to get completely wiped out. DC and Virginia, like Tyson's Corner, they'll probably have an economic depression there. It all depends if they're reducing regulations, bureaucracy, and red tape, because we want the private sector to grow. We want the entrepreneurs out there. We want them out there producing more goods and services. So if you, let's say, fire 100,000 government workers, it's going to be bad for them. But on net balance, it's going to be a positive if you're reducing regulations, bureaucracy, and red tape, because that's what's going to allow the private sector to grow to the point where they're going to be able to create more than the 100,000 jobs that were lost by just getting rid of all the inefficiencies, which is the main objective of DOGE. I applaud their efforts, but I always take a step back and say, remember, guys, this has to come with the reduced regulation. If you just get rid of, let's say, 100,000 employees and you don't reduce the regulations, then that could be a net drag on the economy, not just in the short term, but potentially in the long run as well. So we've got to compartmentalize things. right? We can't just say that because they're shining a light on all of this waste and all the grift, that is absolutely 100% good. But at the same time, if we look at it through an economic lens, it's going to be a net positive just so long as we focus on what we really need to. And that's unshackling the private sector so they can do what they do well. My point with Trump is, look, if you want to do this and you're looking at this strictly through a lens of taxes, right? Because that's what your question was. Now we could look at it through economics, through jobs, what it does to China, negotiating tactics. Those are all separate issues, right? But if we look at this just through the lens of tax revenue and, bring in more money for the government, my big thing is we've got to increase efficiencies. We've got to reduce the size of government, reduce it. So before we have an external revenue service, we need to eliminate the internal revenue service. We don't want both, because I know the argument is, well, once we get the external revenue service up and running and we're creating all this revenue, we're all going to be rich because we're making so much money in tariffs, then we can go ahead and reduce the IRS or eliminate the IRS. And I can assure you that's not the way it works. You're going to end up in 10 years with both, and the external revenue service is going to be even bigger of a monstrosity than the current IRS, and you're not going to have one of them. Like I said, you're going to have both. And by the way, you have to think this through, which I don't think many of the Trump fans have done. Because if you want to source all of your revenue for the government, let's say, through these tariffs, which is what Trump talks about going back to the late 1800s, early 1900s, but you also want to bring manufacturing back to the United States. You're saying you want to reduce the amount of imports. Okay, well, if we are successful in bringing all those jobs back to the United States, you're going to bring your imports down to almost zero. Okay, but that's where you're making all of your revenue. So the better you do over here, the worse with this plan, the worse you do over here. And I don't know how you square that circle if you're someone that believes in Trumponomics or something like that. I'd like to hope that the tariffs are just a negotiating tactic. But I think as far as an economic policy, whether it's through jobs or tax revenue or anything like that, I don't think it's a really good idea. Another thing that people don't really think through is every single good that we import into the United States already has a tariff on it. It's called transportation costs. So let's think about it. All else being equal, is it cheaper to buy a widget from China or from the United States, if assuming wages and everything like that are all the same? Well, it's going to be way cheaper to buy it in the United States. Why? Because you don't have that transport cost shipping it across the Pacific Ocean. That's not free. So that's a tariff. You're increasing the cost. And so we have those tariffs. So why haven't those tariffs created all these additional jobs or U.S. manufacturing? I think it's just a question that we need to ask. Look, this argument drives me crazy when I hear this on social media and whatnot. You're competing with a communist country, for heaven's sakes. You don't think that they've got any drawbacks to doing business in China? And I love the argument that, well, they're a currency manipulator and they have all these tariffs, so we need to have tariffs. Well, that argument is okay. Well, they're doing central planning so awesome that we just need more central planning to be able to compete with them. No, I've got an idea. How about free market capitalism? How about that? So they can do all the stupid tariffs against the United States. They can have cheap labor. They can destroy the environment. They can cheapen the yuan. They can do all that nonsense. Well, fine, but they still have central planning. And last time I checked, that wasn't very efficient, right? When you have to check every single thing that you do through Xi Jinping, you don't think that is a headwind to you doing business? Of course it is. And if in the United States, we don't have those headwinds, then that allows us to compete. I use the example of basketball. Let's just say they've got a 7-foot guy, and we're saying there's no way we can compete with them unless we have a 7-foot guy. No, that's not true. We just need a 6'5" guy that's a hell of a lot faster. And then we're going to beat him every single day. So I would much prefer to make our businesses or our products, let's say, a lot better, and that's how we compete with them, instead of just making their products a lot worse, right? Because at the end of the day, if all we do is just make their products worse, in other words, more expensive, then that's just going to impact the consumer, right? And then the consumer loses, and you say, well, we've got all these jobs, great. So let's just think that one through. So you increase the prices at Walmart that has, let's say, 100 million American shoppers on a weekly basis just to bring back 10,000 manufacturing jobs. That doesn't make a lot of sense to me. And then another thing you have to think about is the strong dollar. And if you have a strong dollar, that could completely offset the tariffs. Because if I'm a Chinese producer and I've got a 25% tariff, if the dollar goes up 25% relative to the yuan, I can just lower my price. by 25 and I still get the same amount of yuan cash flow to pay my expenses. You see, so there's a lot of these factors and people like to look at it through a lens that's oversimplistic. And I think when you do that, you lose a lot of the accuracy. But again, it goes back to the fact that these tariffs are fantastic negotiating tools. There is no doubt about that. But as far as an economic policy, you've just been sold oceanfront property in Arizona.
Right, so what do you all think? Do you want me to share that video with you if you want to watch it again? I'm going to subscribe to this channel. Looks interesting. So I'll put that in the chat box for people. So just quickly, what did you think of George Gammon? Yeah, I'll put the link in there for everyone. So yeah, I was very impressed with this guy. By the way, for the mastermind members, I'm trying to get him to come and present at our mastermind. How cool would that be? Glenn, a little over my head. Dude, I promise you, you know, like when you say it's going over your head. I was sitting there with my iPad. I was making notes. I was like, I'm so glad I'm recording this because then I can chat GPT it, which is what I've done for you here, so that even I can read through it again afterwards to try and understand. Just by the way, Camille said independent thinker. He lives in Chile because his logic was, you're not going to tell me where to live and you're not going to tell me how to live and et cetera, et cetera. So he lives in Chile, and that's why he calls himself rebel capitalist in terms of where things are going. So I wanted to show you this thing here. I'll come back to my what's his name, but let's just go here. So the Bank of England. Okay, so I'm going to share this with you as well. But this is where he was. This is where he was showing us how basically money's made. So he was. So if you want to, I'm not saying everyone will want to do this, but he was basically showing us from this. I'll put this in the chat box as well. If you want to understand how the commercial banks make money, like literally like out of thin air, is like, so basically he was showing here how you got the central banks, you got the commercial banks, and you got the consumers. Okay. And it basically explains how this all works. And then it went on to let's just go down to, I need to find you the right slide. Where the hell's it gone now? It talks about the FX printing. I'm trying to find you the right slide quickly. Is this the right one? Yeah. So he went through this whole PDF. He went through and explained it. Now to Glenn and to myself, this is where my brain was like, holy cow. But basically he was showing how when someone buys and sells a house, how the money moves. And then when you know, with the bank, how that actually moves, and effectively how money is created. And then he went on to show how they're doing that with FX swaps. So where's the FX swaps gone? So I don't know what page it was on. But for the left brainers out there that want to go into all the detail, it's all here. You can go read all about it. Come on, where's it gone now? Just by the way, if this is all very overwhelming, that's exactly why we work at the mastermind level with our family office, because you don't have to understand all of this stuff. You know, we sit down once a month and Anthony takes us through what do we need to know, what's going on. Like, you don't actually have to have a deep understanding of all this stuff. Where the hell's that bloody thing gone? Anyway, sorry, I don't seem to be able to find it. I don't know why it's not coming up here. But I didn't, let me just go back to my pictures. I don't think did I take what page it was on? 6 of 8. That's interesting. I'm much further than 6 of 8. Anyway, I'll share this with you. Because it doesn't seem to be coming up, that particular picture. But in simple terms, he was just, I've already shown you how they create money. I must have missed it. How they create money and how there's $130 trillion, and how this whole article was around how money's made. So money in the modern economy, money creation, and then basically dealing with the banking crisis. I don't know if people want to read this in terms of this article. I haven't read it, and I probably won't. But I've put it there if you are interested. I know that this part here, in terms of how banks make money and all this, is people like Robert Kiyosaki have been teaching this, for ages, and I haven't actually seen it, such nice diagrams before. I don't know what everyone else thinks in terms of that process. So just a couple of other things that I think are important here in terms of, if I come back, let me go through, what's the time looking like? Let me go through this. So the key takeaways here are: hope is not a strategy. Understand the real mechanics behind interest rates. So again, that effectively is growth. Deficits do not equal rising rates. More debt does not automatically mean higher interest rates. Growth and inflation expectations are key. So the long-term rates track the nominal GDP, so the economic growth expectations. Banks create money, not the Fed. So that was really interesting. He drew a picture, and he said most people think that if you take the solar system, the sun sits in the middle. I drew a picture here. I don't know if you'll be able to see it. So I don't know if you can see here. Oh, no, actually, I'll tell you what I'm going to do. Let's do it like this. So there's no way to kind of, I can only talk these things through. Right, let me just go here, AirPlay, share. Okay, so now I want to, okay, I got you. So what I'm trying to show you here is, if you take what are you seeing, just in my interest? Are you seeing my screen? Hello?
It's only,
No, we see
it's a blank screen at the moment, Scott.
it says Scott Picken has started screen sharing, but it's just black with white text.
Shit, man. I don't know why it's doing this. Now?
It's the same.
Now we see it. We can see it.
Okay, cool. Okay, so what he was basically showing here is that the Fed, most people think that the Fed is like, if you take the solar system, the Fed is the sun, and the commercial banks are all around the Fed. But what he was basically showing is that the commercial banks are the ones that are making the money, and it's the Fed that is effectively the planets. Because the Fed, so the commercial banks print money, and by creating money, they drive growth in the economy. And the growth in the economy is then what the Fed has to determine whether it's going up or down based on interest rates. So if you look here, what he did is, like, if you go through it all, I'm not going to go through all my notes, but he said what contributed to inflation was the supply shock. So again, COVID, like the supply stop, the fiscal spending, so the increase in velocity of capital, and then the money expansion, the commercial banks, and he said, yeah, this is the most important thing, and because it's based on risk and reward. So, and that's why that Bank of England thing is so important if you want to really understand how this all works. And then he basically went into this part here where he was explaining this massive risk, where the global economy, the total size of the global economy is $120 trillion, but the derivatives market is $130 trillion. So the derivatives market is bigger than the entire world economy put together. And the dollar derivatives, they do 2 to 3 trillion a day. JP Morgan alone does $10 trillion a day. I find this quite astounding. And then pretty much where are interest rates going? Well, again, If you think there's an increased risk where the growth is going to grow, or if interest rates will come down, it all comes down to the economy. This is how you predict interest rates. The global economy slows down, they'll go down. If the global economy heats up, it goes up in terms of that process. So that's what I wanted to share with you. Let's go back to this. Let's go back to this PDF. I know that I'm overwhelming the hell out of you. I was overwhelmed, just to be clear. But this is the macro. I think I told people that I was quite surprised by how much substance this course had. Okay, so risk and reward. So banks choose between treasuries or lending into the economy based on perceived global economic strength. So what that basically means is that if they've got money, the bank has money, they can either lend to a business or they can lend it to the American, like they can basically buy an American bond or something. And so if they don't think that the economy is going to go well, then they'd rather just take the safe option and not put money into the market. If they put money into the market, then it's because they think that the global economies are going to go well, and that then drives inflation, which then drives interest rates. Then he basically said here, oil, tariffs, and QE are distractions. Only credit creation from commercial banks leads to sustained inflation. And then watch the global economy. The US bond market responds more to global trends than domestic ones. So again, it's, so just quickly, just type in the chat box, do these 7 takeaways, do they make sense? Because obviously I was in the room and I'm trying to give context, but I also need, if anyone's got questions, put your hand up, because I don't know what you do or don't know. Okay, what I tried to ask was the action points for investors. So track growth and inflation indicators, not just deficits or Fed statements. Focus on nominal GDP to anticipate long-term rate movements. So again, do we think economies are growing or retracting? Just by the way, he had a comment here. China, Australia, UK, Germany, Canada, and Switzerland, all of their economies are doing poorly. And Switzerland specifically has negative interest rates. Then this is where it goes into more detail. So the big question is what drives interest rates? And this is the whole growth versus inflation. So you can go through this, how money is really created. So this is what I've already shown you with the commercial banks. This arbitrage play was what I really struggled to understand. But basically, you borrow money in euros and you lend money to the Cayman Island banks. You borrow at 2%, but you then buy treasuries at 4%. There's very little risk, and you're making a 2% margin call. Now, there's no risk in that, but if the economy is doing well, you could lend it to a business at 8%. And this was the whole idea of risk and reward, where if the commercial banks think that the global economy is slowing, then they're just going to buy treasuries. And if they think it's growing and they can make more money at 8%, then they're going to do that. And this was all about the euro dollar and how they effectively are borrowing between the euro and the dollar to achieve this. Inflation, oil, and the real triggers. So again, I found it really interesting where he went on and on about how oil was actually irrelevant and the printing of money was irrelevant. What does it mean for real estate? The forecast mortgage rates, real estate investors must assess. Is global growth accelerating? Expect high interest rates. Is global growth stagnating, declining? Expect lower. If growth expectations fall, interest rates fall. If they rise, so will they rise. Final word, forget the Fed, watch the real economy, commercial banks, and global credit trends. This is how the top 1% predict interest rates and how you should too. And that is a PhD in economics. So I'm not going to stand here and try and say that I fully understand everything that he tried to explain. And when I was in the presentation, it was a 90-minute presentation. And when I was in the presentation, for the majority of it, I didn't really, I was trying to get to grips with what he was actually sharing. And my synopsis, and that's why I started off right in the beginning before people felt overwhelmed. My synopsis at the end, and what I liked was he made it very clear at the end, was that all he was actually doing was proving all the theories that everyone else thinks that drive interest rates wrong, and then showing how the commercial banks print money, and then showing how that is either happens or doesn't happen based on economic growth, and how that 100% then dictates to the Fed whether they should put up interest rates up or down. And obviously not just in America, this is anywhere in the world. And based on that, that's how you make your predictions. So that's what, the Fed is the Federal Reserve. So they are, so like in South Africa, we've got the Reserve Bank here as well. And they're the ones that determine whether interest rates go up or down. So they effectively manipulate an economy where if interest rates are higher, the way it's supposed to work is that when interest rates are higher, the people borrow less money, and so the economy slows down. So if the Fed, the Reserve Bank, is trying to stimulate the economy, they drop interest rates because it means more people borrow money, and it sort of fuels economic growth. And if they're wanting to slow economic growth because inflation's too high, then they put up interest rates to slow the economy. I hope that helps. Okay. So I need some help and guidance now. What can I help with? Are there questions? Are there thoughts? Are there fears? What can so this is my intention, is that each week I'm going to go through one of these and try and explain it, because I'm sure there's always some substance behind. This is only a 2-page cheat sheet. But what I don't want to do is overwhelm people. I do think this video that we've got here is an excellent little video, because this is exactly what he spoke about. He spoke about tariffs. He spoke about the fact that Trump wants to put up tariffs, but they've got no manufacturing capability in America anymore. So even if they wanted to, they can't manufacture stuff in America. So it's a double-edged sword in terms of the overall process. And then this was, really where it started to blow my mind. But this whole, how do the banks make money, and the fact that it's the commercial banks that drive the economy, not the Fed. I'm seeing a lot of glum faces. You can imagine I started on the Saturday morning, and the very first presentation was, what are the single biggest fears of all investors? And we went through that, and the next one was George Gammon and the fact that the world economy is 120 trillion, and the Forex exposure is 130 trillion. Yeah, this is exactly part of the education that Robert Kiyosaki is talking about. Just by the way, I've just seen a video here that came out one day ago.
So I'm asking one big financial question.
Sure.
So I haven't watched this myself, but it literally came out one day ago. And I assume that this will be everything that Robert was talking about on the boat, which was that, basically it's happening right now. So someone actually asked me about the collapse, and I asked Robert about this, and he basically said it's already happening. And I was like, what do you mean? He said, no, it's because the bond market is unraveling. And if you remember last week, I told you about this. The central banks are no longer trusting the American Treasury like they used to, and they're now buying gold. So the Treasury, the bond market, the American bond market, which constitutes 90% of the entire world bond market, used to be the go-to place, the safe haven when people were nervous. And it used to be number one, and gold used to be number two. Gold has now replaced the Federal Reserve. And so gold is number one, and the Federal Reserve is number two. And this is exactly what Robert and Peter Schiff and George Gammon were talking about. Now, I haven't watched this video, but I would suggest probably watching it because it literally came out one day ago. I'll put it in the chat box. Okay, so let me look and see if there's any questions that I haven't answered. Oh, sorry, I wasn't sharing my screen there. Was I sharing my screen? Sorry, I meant to show you this. this video that's just come out from Robert Kiyosaki. It literally came out yesterday or one day ago. So yeah, it's a 30-minute video, but it's all about, I don't know what it's about. I haven't watched it, but 11 countries just the dollar. China's building a digital currency to replace it. Meanwhile, Americans are stuck holding paper assets while the system crumbles. So you see here, the inflation in the bond market. I'm definitely going to watch this. Looks really interesting. Anyway, right, let me see what the questions were there for everyone.
Susanna has some questions.
Yeah,
And Jane had a question.
I'm just going up back. I just went up to the top to make sure I started.
Okay.
Yeah, so I think Camille, I'm in agreement with you. That's what I was trying to say about losing confidence in America. We've got the links. Please tell us that was the most complex one first. George Gammon and Peter Schiff were the two hardest ones. So Peter Schiff equally was tough. But that's why I like ChatGPT, because it sort of takes, imagine sitting for 90 minutes and trying. I mean, you just watched a 10-minute video with that guy. Imagine sitting there for 90 minutes. And then also he was on about 3 panels, and him and Peter Schiff disagree with each other. So they would have fierce arguments in a panel. And now you're trying to keep up with both of their sides of the argument. So yeah, it was, the first 2 days were pretty hectic. This is valuable insights as to how the banks thinks as they do what they do. Yeah. What are the treasuries? Money or wealth held by a country. So treasuries are, and this is where I need Anthony, but anyone can call bullshit if they think I'm not explaining it right. But my understanding of the treasury is let's Google it to see what comes up. But so the management of money of the financial resources. In a government context, it's the department responsible for managing public funds, budgeting, the national debt. So yeah, it's basically the American economy. It's the people managing the American economy. Susanna, the Fed is the Federal Reserve. Yeah, this part, okay. So if there's 130 trillion in derivatives, when are they? I don't know, Connie. Peter Schiff was the most negative, and he thought that the House of Cards could come crumbling down in Trump's administration. I've just shown you that video with Robert Kiyosaki. He also thinks that things are precarious at the moment. The biggest problem with these derivatives is that if someone suddenly loses confidence and there's a run, and by the way, he actually spoke about it here with Silicon Bank. So I don't know if you know, but Anthony actually did a session for us at the Mastermind on why Silicon Bank in America went bankrupt. And the reason being is that they were doing Forex swaps exactly like this. And then the interest rate went up and they got caught on the wrong side of a transaction. And that's why they went bankrupt. So unfortunately, it can unravel very, very quickly. And the question is not, and again, just to kind of put everyone's mind at ease, the overall feeling from all of them was, be prepared. So it's nothing to be scared of, because it's going to happen, whether you like it or not. So it's not about being scared, it's about being prepared. And the single biggest thing that they were recommending was diversification. And it was interesting because I've done a lot of stuff in America. I mean, I've been investing and presenting in America since 2011. I've never in my life heard Americans telling people to diversify outside of America as well as like America. Should we continue with the S&P 500 if you're retiring in the next 7 years? Yeah, I don't know, Judy. I think, you know, this for me is a much better question to ask Anthony and the team. But I think one of the things that one would certainly look at, and if I look here, what you don't want to do. So let me just find my presentation here. What you don't want to do is be what most people are. So Robert Kiyosaki literally said he expects the baby boomers to be wiped out by inflation and by all of their money is in the stock market, the 401ks. And basically, if you look here, you've got bonds. The typical person has bonds at 30% and stocks at 70%, and they're in the highest risk, lowest return category. And just by putting 20% in of private equity as an example, you can dramatically change that. Commercial property, gold, silver, crypto, etc. So that's why of the 579,000 wealthiest people in the world, more than 50% of their money is in alternatives. And remember, alternatives are not bonds or stocks. I know most of you have seen these slides, but hopefully repetition is the mother of skill. So if we had to invest in one asset class this month, would gold be it? Yeah, so interesting, Susanna, I don't own any gold, okay? I want to tell you a funny story. I forgot to tell you last week the story. So I don't own any gold. I've never understood gold. It doesn't actually make any sense to me as an investment because I like assets that pay me an income. And gold, I mean, this thing could be gold. It's not, but if it was, it doesn't pay you anything. It just sits there. So I've never even looked at gold or silver because I like assets. You know, I like chickens that lay eggs. But what was interesting was they completely woke my eyes up to gold and the fact that the central banks are all buying gold and that gold's gone from $2,000 to $3,300. And in simple terms, the real opportunity is actually silver, because the gold to silver ratio over the last 2,500 years has been 15 to 1. So that means that for 15 ounces of silver, you can buy 1 ounce of gold. That is the 2,500 year trend. And right now it's sitting at 93 to 1, which basically means that silver is significantly undervalued according to gold. And by the way, I don't know if you noticed that. I love this stuff. I don't know if you guys enjoy this, but while I'm talking to you, I'm also picking up stuff. If you look here under the Robert Kiyosaki video that I just showed you, I mean, I literally found it while we were talking. Do you see here? Robert Kiyosaki believes silver could hit 70 in 2025, and it may be the most overlooked asset in the world right now. Maybe that's answering your question. But let me finish with a story. So they've got a thing, which, by the way, we're going to do at the Wealth Weekend, called the Texas auction. Okay. So let me get my whiteboard because I want to draw a picture for you. Actually, no, I don't need my whiteboard. I'll do it on my iPad. So I don't think any of you would have ever done this because I'd never seen it before. But it's called capitalism without currency. So I'm just sharing my screen. Just give me 2 seconds. Okay, so the way this works is, if you can just imagine, you've got someone that offers something. Okay, so a lady offered a holiday in Belize for a week's holiday in Belize. Then a whole bunch of other people said, right, for that week's holiday, I will give you this. And then based on whatever that was, a whole bunch of other people offered. So that, are you with me? So you end up getting a board with like millions of lines like this. Okay, now what I'd never played this before, but the key is to be this person. Because the person at the top can choose anything they want below. So because everyone here has offered, so this person offered, I don't know, let's just put something. But for that something, they offered it for that, and that person offered it for that. So you can do a three-way trade. Because if I want that, I basically just get that, give it to that person. Do you understand? Are you with me? Like it's trading, it's bartering. Are you with me so far? So on day 2, they did this twice. On day 2, when I saw that the lady offered a holiday in Belize, because I had no idea what the things were you're supposed to offer, I offered a holiday in Knysna. And I told everyone about South Africa and like South Africa's Knysna is the #1 holiday town and whatever. Well, I had an overwhelming. I couldn't believe how many people wanted to come to Knysna. By the way, for me, it's free. Like they come stay in my house, they stay in my flat, they come and have a holiday, yeah, whatever. Okay. So I was offered about 20 things down the bottom here. Yeah. So the next time they played this game, I upped the ante to make sure that I was the yellow. Because I wanted to be this person. Because if you're at the top of the thing, you get to choose whatever you want. So let me stop sharing now so you can see me properly. So I offered a week's holiday in Knysna. You can come out to the Wealth Weekend. You can meet, a group of like-minded people who are all investors, blah, blah, blah. Anyway, like I'm a salesman, you have to sell. Okay, so I gave away my week. You know what I got in return for that? And I'm now answering your question, Susanna, because I now do own gold. I own 2 ounces of gold, 10 ounces of silver, 6 months of coaching on crypto and Bitcoin, 1,000 shares in an oil company, shares in a bank, a new bank that's been started. And there was one other thing. I can't remember I need to go look at my notes because it's something else. I got all of that for my holiday in Knysna. Okay. And you know that my holiday in Knysna beat a Harley Davidson. So that's how badly people want to get to the top because you can then have anything. So one dude offered a Harley Davidson as the grand prize at the top, and I offered a week's holiday in Knysna, and I won, which basically means like the crowd votes which one's the better one. But the thing that's interesting here now, I don't own any gold or silver, or I didn't until 2 weeks ago. 2 ounces of gold. So I'm like sitting there. Okay, if I hadn't been to this investor conference, I wouldn't have known any of what I'm about to say. Oh shit, I need to go to the investor update. Anyway, I just want to finish very quickly. 2 ounces of gold, $6,600 value. 10 ounces of silver, I don't know, another $300. That's $7,000. Okay, like I'm already nearly there to paying off my trip just by getting the gold and the silver. Pretty cool, eh? Anyway, and on that note, I'll see you next week, but I have to bounce because I've got the investor update now. I hope it helps. I would love feedback from people because I don't know how to do this. I'm improvising as we go to try and give you the feedback of everything I learned. Okay. Cheers, everyone.